Today, the UK travel sector produced two numbers that should not coexist. WHSmith fell 19% after its third profit warning of the year, cutting pre-tax guidance to between £75 million and £90 million, down from £90 million to £105 million just months ago. At the same time, easyJet shares have gained 21% in a month, and Deutsche Bank has just raised its target price to 540 pence from 340 pence, a 59% lift, while simultaneously upgrading from sell to hold. Both companies derive revenue from the same physical infrastructure, airports. Both face the same headwind. WHSmith explicitly cited falling passenger volumes at U.S. airports as a direct consequence of the Middle East conflict. The airline's revenue was down 2% year-on-year in the 7 weeks to 6 June. The logic that crushed WHSmith should run through the same pipeline and reach easyJet, yet institutional capital moved in opposite directions. The divergence is not noise. WHSmith raised £102 million from institutional investors on the same day those same investors were being asked to price easyJet's recovery story. One set of airport-exposed institutional holders sold hard. Another set, anchored by U.S. private equity firm Castlelake, bought in. Castlelake disclosed a 2.14% stake in easyJet and stated it was considering a possible offer. Deutsche Bank's analyst Jaime Robocalm did not upgrade because the airline's unit economics improved. He upgraded because, as he stated explicitly, growing investor interest has shifted the balance of risks. That distinction matters. The session's travel capital flow was not consensus directional. It was a split between holders pricing easyJet as an operating airline and a new entrant pricing it as something else entirely.
The asset that separated Castlelake's thesis from the prior sell consensus is not the route network, not the fleet, and not passenger load factors. It is easyJet's airport slot portfolio. Airport slots, the rights to land and take off at specific times at congested airports, cannot be easily manufactured. At Gatwick, Luton, and Amsterdam Schiphol, slot allocation is governed by international frameworks that make new entrants structurally disadvantaged. easyJet holds a concentrated position in these constrained airports. Castlelake, which already leases 4 Airbus A320neos to the airline, entered this position from the aircraft leasing side, meaning it already had direct knowledge of what the fleet is worth in liquidation terms. That is the unstated premise beneath the prior sell consensus. Analysts covering easyJet as an operating airline valued it on earnings multiples, discounted cash flow, and passenger revenue per seat. Each of those metrics has deteriorated under fuel cost pressure, cost of living squeeze, and now Iran-linked demand softness. Deutsche Bank's former 340p sell target was built on that operating framework. Castlelake's 2.14% entry is priced on a different framework entirely. What is the slot portfolio worth to a buyer who would not operate the airline as currently configured? easyJet's board described the approach as highly opportunistic. The word choice is itself a signal. Opportunistic relative to what? Relative to a share price that has fallen 40% in 12 months and is now back to 2011 levels. The board's rejection of the framing, not the offer, is what left the stock's repositioning path genuinely open. Deutsche Bank's target revision to 540p does not model a return to 2019 earnings. It models the floor that the slot asset value creases under the share price. That floor is now the contested terrain.
The question the session did not resolve is whether easyJet's board moves from "will consider any proposal" to an active engagement process, and on what timeline. The Gamma Communications precedent is visible in today's UK deal flow. That company extended its own takeover deadline to 8 July, demonstrating that London-listed boards are comfortable letting PE offer processes run long. easyJet's board has not set a public deadline. What changes the calculus in easyJet's favor is the same thing that creates its risk. The slot portfolio's value is a function of slot coordination season allocations, which run on a winter-summer schedule. The summer 2026 season is already committed. If Castlelake's approach moves to a formal offer phase before the October winter allocation deadline, the slot portfolio's valuation framework is live. If it does not, and passenger demand recovers through the World Cup summer, Fuller's pub chain reporting 4.4% like-for-like sales growth in the 10 weeks to June suggests that UK consumer leisure spending has not collapsed, then the operating airline thesis re-enters the pricing contest. The parallel that surfaces here is IAG's acquisition of BMI in 2012. IAG paid £172.5 million, a price that most analysts described as above fair value for a loss-making airline. The actual target was BMI's Heathrow slot allocation, which IAG subsequently used to build its transatlantic franchise at Terminal 5. The operating business was wound down within months. easyJet's situation is structurally distinct in that the airline remains profitable at the group level, but the logic of that 2012 transaction is precisely the unstated premise that Castlelake's entry is now forcing into the pricing frame. If easyJet's share price holds above 400p through the summer, the level Deutsche Bank implicitly treats as the slot floor, the operating thesis and the asset thesis coexist, and neither forces a revaluation. If the share price falls back below 300p while Castlelake increases its stake, the slot value argument gains structural control. Watch the 400p level, the Castlelake 13F disclosure timing, and whether easyJet issues any summer capacity guidance that signals operational rather than asset sale intent. One of those two readings will have to give ground before October. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.